This is pretty good.
Good evening, everybody. Welcome to week 6. I'm going to warn you in advance, give you plenty of heads up. Now's the time to get a bottle of wine. Now's the time to get a lot of sleep. This is the most important class of this fall session, week number 6. Of any class that you will use in your further academic studies, be it undergraduate or graduate in finance and business, this is the class. And that's why we had the Game of Thrones introduce our class this evening. It's huge. So Paulette's got her background on. She's ready. Rudy's ready. We're ready to go. Capital budget analysis. Chapters 8 through 12, all summed up in one problem we're doing tonight in class. And then you're going to practice that format and problem in assignment number 3 this week, due next Tuesday. It is posted already to Blackboard if you want to get a snoop at a look at it before. But we will talk about that later on this evening. Our job tonight is to learn the process of determining what it cost us to get capital, where we invest that capital, and is that capital going to generate enough sufficient cash flow to generate enough return over and above the cost of that capital. Every business entity in the history of mankind has at some point in time done a capital budget analysis for all their services and all their products they offer for sale. This is important. We started out last week with this spreadsheet. We looked at chapter 8. Remember this? When we did this problem in chapter 8, talking about an investment of $200 in 2 projects and the cash flow that would be generated from those projects, and we determined their return in dollars, called net present value. We determined their return in a percent, called the internal rate of return, their return in a ratio, called profitability index, and their return in years, called the payback. Then we looked at a problem. The question was, well, how do we determine these cash flows of $80 and $100 that were given to us in this problem? Well, that's what chapter 9 is about, where we went through and we determined, based on the variables given to us, what the investment was in year 0, what the amount of revenues and expenses and depreciation was involved in this particular problem, what was their tax rate, what was their working capital determination. We put all those together and we came up with the cash flow of this project, an investment of $53,000, generating approximately $62,000 in cash over its depreciable life of 4 years. And then we calculated the return analysis in dollars. Loser. We calculated the return in a percentage. Loser. We calculated the ratio in profitability. Loser. And we calculated that the payback. Loser. In other words, the return in this problem did not meet the expectations of the project cash flow that it was planning on generating. Back to the drawing board. Tonight, we're going to look at another example of a winner, a project that generates a lot of cash flow and return. You're going to be looking at another project in assignment number 3 as graded work for next week. And you're looking at a project now where you have to do the same type of thing in the Road Kings case. So as you can see, there's a lot cooking here for this week 6 of our course. So if you get a little fuzzy, that's why we have this video. That's why we looked over those problems last week, and we're going to look at this problem this week. Now, where is this problem located in our Blackboard? Let's make sure I introduced it in our introduction video of a couple of days ago. So let's see where that sucker is in this portfolio or in this Blackboard. We go to week 6. Week 6, capital projects, part 2. And here it is right here. Class lecture spreadsheet. Week 6, capital budget analysis. This is what I'm going to be doing and filling in this spreadsheet tonight. The exact, except the names have been changed to protect the innocent, spreadsheet you'll be using as a template for assignment number 3. The exact template, the names have been changed to protect the innocent for the Road Kings case. This is your template for this work. You're being given it, and now we're going to see how we all put it together to determine a capital budget analysis. There it is, right there, if you want to follow along. If not, that's okay too. All right, let me make sure everybody looks somewhat normal tonight. Melanie, where in the hell are you?
In the sky.
In the sky. Melanie's been nipping on the wine already this evening. So we'll let
I just got off of work, so I'm still work delirious.
Refresh my memory. Where do you work?
I work for the housing authority here in my city in Bakersfield.
Ah.
So I manage a senior living facility of like 200 people.
Save a place for me in a couple of years. I might need it.
You don't want to go here.
No?
No.
Melanie, do you know Norma Dominguez?
Her name sounds familiar, but I don't know.
She's the director of the Bakersfield campus.
Oh no, then no. I that's why it sounds familiar, because I've seen her name, but no, I don't. I've actually never been to the Bakersfield campus.
Oh.
I started like when COVID hit, so I never even got to meet anybody in person for Laverne. I've only dealt with people via Zoom.
So we need to work on our personality skills.
Yeah.
That's a joke. That's a joke. That's a joke. Okay. All right. Thank you, Melanie. All right. There's Darlene. She's looking very nice as usual. And Dustin, always smartly attired. Thank you, Dustin. And Paulette, that background is amazing. All right. Everybody else is hiding out in the world of the darkness of the internet, but that's okay. All right, let's get back to that spreadsheet. This is what we're going to be doing tonight. And again, if you're not a numbers person, this can be very intimidating. All right, and I understand that. But if you're a business major, you got to know how to do this. Your capstone class, that's the last class that you're going to have in your business program, you're going to be doing or referring to something like this in this class. And this is what a capital budgeting process is all about. And this is what it's all talked about in chapters 8 through 12 of your textbook. I'm condensing all of that nonsense into one problem. So you don't have to worry about reading the whole chapter. It's all going to be talked about in these 6 steps. 1, what are we investing in? What are we purchasing? What equipment, what building, what land are we investing in? What is our asset investment? 2, what is the depreciable life of this asset? What's the financial life of this asset? How many years? 5, 10, 15, 8, 7, 20? What's its depreciable life? And then what type of income is going to be generated from this investment over the depreciable life? And what will our operating expenses be? Operating expenses designated by variable expenses and fixed expenses. And we'll talk about that. And then once we take into that net income, revenue and operating expenses to determine net income, what is the net cash flow generated besides that net income? Working capital, salvage value, depreciation, all additional cash flow items to determine the cash flow. And we looked at that last week a little bit in that chapter, in that problem from chapter 9. Then once we determine that, we determine the 4 returns on an investment analysis that we practice: net present value, internal rate of return, profitability, and payback. And finally, we do a risk analysis. What if things change? What if what if our variables change? Can we still salvage this investment? Now, the good thing about this list, you only have to know 5 of them. The risk analysis, you don't have to worry about. We're just going to cover the first 5. The first thing we have to do before we do anything else is take an analysis of what our money costs are in our company. What does it cost us to get money? I'm sure if I went to Marissa and say, hey, Marissa, what does it cost you to borrow money? And Marissa would probably say, Mr. Hassey, that's none of your business. And she's rightly so. But then she would say, Mr. Hassey, if I wanted to get a car loan today, because I just got one, my cost was 3%. Okay. That's Marissa's cost of borrowing money, 3%. If I went to get a home mortgage today, which I would never do again for the rest of my life, is I would get a mortgage and my mortgage would be about 1.75%. All right, that's my cost of capital, the mortgage that I'm getting. If I'm a person who's 21 years old and just got out of college, and the only credit I have is a credit card from Dewey, Cheatham, and Howe Bank, my interest rate or my cost of money is 23%. Because I don't have any other credit. I don't have any other income. They just gave me a credit card because I'm a graduate of college starting out. My cost of capital is 23%, which is the interest rate on that credit card. But for corporations, it's a little bit more complicated. But basically, it's the same thing. What does it cost us to get our money? It's called, for our analysis, the weighted average cost of capital. This is talked about in chapters 9, 10, 11, and 12. What this is, it's the risk in the market. What is the company's risk in the market? What is Professor Hassey's risk in the market today? It's my FICO score. That's my risk in the market. It's my FICO score. What is a company's risk in the market? It's their credit rating. It's their credit view of their credit in the market. So what we're trying to determine here is if this company needs to raise capital today to start a project, what is it going to cost them to get the money? That's what this analysis is. You're going to be doing this analysis in assignment number 3. You're going to be doing this analysis in the Road King case, the cost of capital. And it's all based on 3 things. The relationship of the capital structure of a company. What is the capital structure? We've looked at this a little bit. It's the assets of the company equaling the debt plus the equity. The debt and the equity is the capital structure. It's how you funded the assets. All right. For most of us in this class tonight, all 20 of us who are sitting here tonight, I'm willing to bet any amount of money that most of us, our capital structure is anywhere between 80 and 95% debt. Most of us have very little equity. most of the population in America has very little equity. 1% of America are rich. The rest of us, we just get enough to get by, including yours truly. So our capital structure, our payments are the way we get assets. It's mainly driven by loans, car loans, mortgages, credit cards, that kind of stuff. We have very little equity. Well, in corporations, it's a little bit different, but it's the same thing again. What percent of the company is in debt? What percent is in equity? For this company here in our example for tonight, this company is 60% debt to assets. 60% debt to assets. Now, if it's 60% debt, that means the equity's got to be 40%. Because remember, see this equation? Assets equals debt plus equity. Assets are 100%. If debt is 60%, that means equity has to be 40% of the capital structure. Okay, that's cool. I got that. That's the weighted portion of our analysis. We weight our cost of capital by what percentage our company is in debt and what percent our company is in equity. Okay, that's item number one. Item number two is what is the cost of this debt and what is the cost of this equity? What is the cost? All right, very easily. In this company, their tax rate is 30%. And the current money that they have borrowed is at 9% interest. Now, this is very general. Most companies have different loan structures, but for the sake of intro to corporate finance, we're keeping it pretty easy, basic. So this company now pays on this 60% of their capital structure, 9% on debt. Kind of high. And they're in a tax rate of 30%. Why is that important? Because if any of you are familiar with the Internal Revenue Service, which I certainly am, for corporations, they can deduct interest expense on their corporate tax returns. Most of us, you and I, can deduct up to $1 million of loans interest on our tax returns. Over $1 million, we can't deduct it anymore. Corporations, it's unlimited. Why does the IRS let you deduct interest? It encourages you to borrow more money and keep the economy going. That's why. That's why we get a tax break on interest. It encourages you to borrow more because you don't have to pay tax on that. It's deducting it from your revenue. So what is my cost of debt? If I have 9% interest on my debt and I can deduct 30% of that interest, I just put that into a little formula here. The cost after tax cost of debt is equal to the interest rate on the debt times 1 minus our corporate tax rate. That equals the after-tax cost of debt. Oops. Sorry. Let me write that again. I just wiped it out. A little bit slow on the trigger today. I've been Zooming all day and I'm a little punchy. There we go. That's it. Oops. Interest rat. Well, sometimes I think interest are rats, but I'll let that go. The interest rate on debt times 1 minus the tax rate. That's how to determine your cost of debt. So if I put that in a mathematical formula, equals my interest rate is 9%, 0.09 times oops. 1 minus 30%, 0.3. So 9% times 1 minus 0.3, which is 9% times 0.7, right? I get 6.3%. So yes, this company is paying 9% on their debt, but after they get the tax deduction on that interest, it's only really costing them 6.3%. That's the cost of their debt right now, today. So what do I do with that money or that interest rate? This is point number 3 of this analysis. I put it down here, 6.3%, and watch what happens. I weight that 6.3% times the capital structure of debt of my company. So it's 60% of 6.3. My weighted cost of debt is 3.78%. Okay. Now, this is where this gets a little more complicated. What is our cost of issuing stock or using equity in the business? It's called the capital asset pricing model, which means in English this: the risk-free interest rate plus the market premium interest rate times the beta of our company. Oh, I did that again. Let me fix this. There we go. That's it in English. In other words, if I was going to issue stock today to the market, to my shareholders, what would they expect to return off that investment? The risk-free interest rate is 2.5%, which is a little bit high in the real world today, but I'll let that slide. 2.5%. If I would take a look at the risk of this in the market, which is better known as the beta analysis, that would have a beta of 0. 0 risk, right? And here's why. If Melanie came to me today and say, Mr. Hasse, I got some money today. I got my hands on some extra money. Where should I invest it? I go, Melanie, are you a aggressive investor or are you very conservative? And Melanie says, Mr. Hasse, I'm very conservative. I've been burned too many times with investments. I want the safest investment possible. I go, Melanie, you want to buy a 10-year United States Treasury bond. That has 0 risk. That's the risk-free interest rate. If you give them your money, you'll get 2.5% interest every year, and you'll get your money back in 10 years. That's the safest investment out there. Why? Because if the government can't pay you, they'll just print more money. You're always going to get paid. There's no risk of losing money if you lend money to the United States government. If you lend money to Apple Computer, there's a risk that they might go in default. Why? Even though Apple makes billions of dollars a quarter, because possibly someday they might not make a lot of money. And you know what? Apple's not like the government. They can't print money. That's why. So if Melanie says, Mr. Hasse, I want the safest investment, I would tell her to buy United States Treasury securities. Now, they're not going to pay very much, but you won't lose a nickel. That's the risk-free rate. Then, if Rudy comes to me and says, Mr. Hasse, no way, Jose, am I getting 2.5%. I want to make more money on my money. I want to buy into the stock market. Can I get into a mutual fund or an ETF or a fund that invests in the stock market with a beta of 1.0? That's average risk. And I go, Rudy, I'm with you on that one. Why should I waste my money at 2.5% when I can invest in the stock market today and earn 10%? Now it's greater risk, but I'm willing to take that risk and have a chance at making 10%, not 2.5% a year. Okay, cool. But then there's Latoya. Latoya is an aggressive investor. Mr. Hassey, I don't want to waste my time at 2.5%. I don't even want to waste my time at 10%. I want to make more money. Well, how about this company here? The company that we're looking at here in our analysis. It has a beta of 1.35. That means it's a little riskier. You're going to make more than 10% from this company because they have a greater risk. And what does that mean? It means they have a history of sometimes making money and a history of sometimes losing money. Okay, I'm willing to go with that. Remember, Melanie doesn't like that kind of stuff. I want to keep things very simple. Give me 2.5%. Rudy says, you know, I want to make some money, but I don't want to risk losing anything. So I'll invest in the market and make 10%. But Latoya says, nah, let's go for it. So if Latoya decides to buy stock in this company here, what is going to be her expectations for return? At zero risk, it's 2.5%. At average risk, it's 10%. At 1.35 risk, it is equals the risk-free rate of let's put that in parentheses, 0.025, that's 2.5%, plus the market premium, which is the market interest rate, 1.0 minus the risk-free rate, 0.025, times the beta of the company, 1.35. I'm sure I did these parentheses right, because sometimes I mess up on this because I'm an old gangster. Here we go. One more parentheses. I think that's right. No, maybe not. Maybe I'm okay. Now let's see if that works out. So I go equal, and there it is. I'm right. Notice here, 12.63% is the return. Wow, Latoya, good job. But there's risk there. There's a chance that she might not make that, but she's willing to take that risk at a beta of 1.35. So looking back on what I just said, Melanie can invest in a product that has zero risk. She's going to make 2.5% this year. Rudy can invest in the stock market and have an average risk of 10%. But Latoya can invest in this company at a greater risk and made 12.63%. That, ladies and gentlemen, is called the cost of equity for this company. It's based on the risk in the market. No risk, average risk, this company's risk. And you put that all together in this formula with the market premium defined as the market rate of return minus the risk-free rate, that spread, that's called the market premium. And you take that market premium and you multiply it times the risk of this specific company, you get 12.63%. And now I take that interest rate and I weight it to the part of the company that's invested in equity, 40%, and weigh it 5.05%. Ladies and gentlemen, Madame and Messieurs, our weighted average cost of capital is 8.83%, based on the company's capital structure their risk in the market for debt and equity. Combine all those and you get our discount rate for our capital budget problem, sometimes also called the hurdle rate, sometimes called the opportunity cost. Those are different names for the same thing. What it cost us to get our money in the debt markets and in the credit market, in the equity markets. And it's all driven by capital structure, the risk of our credit rating to get loans, the risk in the market for our beta, and our tax rate. Combine all these suckers into these numbers, you get 8.83% cost of money. You're going to be using this template in assignment 3. You're going to be using this template in the Road Kings case. You're going to be using this template in your final examination. The next 3 weeks, your life is going to be dominated by this subject. Paulette, question.
Can I see the weighted average, that formula again, where no, not the weighted average, the 12.63?
There it is right there. It's the risk-free rate plus the market premium times the beta of the company. I'm going to be posting this file folder back to Blackboard when we're all done tonight, so you can see these formulas.
I can't see the formula, but okay, I'll go back and look at it.
Okay. This is it in English. This is the calculation. So that's why I gave you both, so you can kind of piece it together. Right now, today, in the United States stock market, yesterday, the stock market went bananas down. Today, it went up again. Why? Yesterday, people thought the risk in the market was too great, so they're selling out. Now all the stock prices dropped, so other people today thought, stocks are cheap, the risk has gotten better, I'm going to buy in today. It changes every day. That's what drives the market. But if a stockbroker calls you up in the next week or so and says, hey, Melanie, I got a company I think you should buy in your stock portfolio, in your 401k or in your IRA, and it's XYZ company. And the first question that Melanie would say is, hey, Mr. or Miss Broker, what is the current beta of this company? And what is the current expected return on investors? Damn, says the broker. You have Professor Hasse in class. You know exactly what questions to ask about the performance and the expectations of this stock. Because if he tells you that the beta is 1.75 and the expected return is 18%, I would get the hell out of there. It's too risky, even for Latoya. It's too risky. It's like going to Vegas and playing craps. The odds are against you from day one. Sometimes you win, but you usually lose. Okay. What you want is kind of even odds. That's why one of the most boring games in Las Vegas, but the odds are the best? Bet red or black at the roulette table. Well, isn't that exciting all night? Red or black at the roulette table, if anyone's ever done that. It's not too exciting, but the odds are pretty much 50-50. Those are one of the best odds in Vegas. But a lot of people don't play it because it's too boring. I'm going to go to the crap table where the odds are well against me, but if I win, yahoo! But do you always win at the crap table? Trust me, you don't. It's the same thing here. Risk and reward. The higher the risk, the greater the reward, but there's an opportunity there that you might not get it. The lower the risk, the less reward, but you're gonna not lose a nickel. That's your decision as an investor. And we balance those out into this 12.63%. So you guys got to remember this one. Capital structure, risk in the market, the weighted cost of debt, the weighted cost of equity, add them all up, 8.83%. Chew on this for a while and come back to me if you have questions. But this is huge right here. But it gets even huger our next step. Now what do? Okay, we now know our cost of money is 8.83%. That's our discount rate. That's our opportunity cost. We now know that we have to invest in an asset that's earning more than 8.83%, or we're not doing anything. So now we have to find an asset that's going to give us a greater return than 8.83%. And now we go to the next tab in this spreadsheet. Hold it, let me save this first. It's called the base analysis. Boom. Oh, Mr. Hassey, this is already giving me an upset stomach. The first thing I do is let me put 8.83% right here. That's my project's cost of capital. And just like we did last week in problem chapter 9, we're now taking a series of variables and putting them into a spreadsheet to determine net income, cash flow, and our return. We're doing the exact same thing. It's just a little bit more complicated because it's related to the real world. And let me explain that. This company now has selected a piece of equipment that's going to cost them $1 million. Okay, that's our investment. We're going to invest $1 million. Okay, this investment has a depreciable life of 10 years. So we can depreciate that $1 million over 10 years. Okay. Paulette, question.
I didn't have a question.
Your hand's up, damn it.
Is it? Oh, no, I was thinking.
That's
Sorry.
okay. That's all right. That's right. When I see a hand up, I always ask if you have a question. Okay. So this has this investment of $1 million. We're going to see, is it worth investing in this asset, $1 million at our cost of capital? Are we going to make any money? All right. So this investment is going to have a lot of variables. First variable, its financial life is 10 years. Okay. The second variable is it's going to have a salvage value of $50,000, meaning we're going to depreciate it $100,000 every year for 10 years. That's going to total $1 million. So we're depreciating this $100,000 straight line over the 10 years, $100,000 a year. That's going to be fully depreciated at the end of 10 years. But also they're telling us here that in the 10th year, we're going to get $50,000 salvage or scrap on that piece of equipment at the end of its life. In other words, we're going to beat the hell out of it over 10 years, and then we're going to sell it for scrap at the end of those 10 years and get $50,000 in it. That's our salvage value. If you guys remember that from accounting, it's also called the disposal value or the scrap value, whatever. But one thing to remember about this, at the end of 10 years, we have fully depreciated the $1 million over time. So this receipt of $50,000 at the end of its life is a taxable gain on the disposal of this asset. So we got to pay tax on that $50,000. So I'm going to take $50,000 and multiply it times 1 minus our tax rate. What's our tax rate? 30%. So I'm going to take 30% off that $50,000, which in fact is $15,000, but I can do it by this equation. I'm going to get $35,000 after tax in my 10th year for salvaging this equipment after I've fully depreciated it over 10 years. Notice I'm beginning to put the pieces in this puzzle. These items up here are net income or accounting terms. Below net income are operating cash flow terms. Salvage value occurs after is cash flow at the end of the life of the asset. Whew. What's next? Well, they tell us in the problem we're selling 25,000 units every year. Now, who in the hell determines that? Well, I'm sure you guys work with marketing and salespeople. They know that we can sell, if we can sell the products that this piece of equipment is going to produce in a market at $20 a unit, that's our retail selling price, $20 a unit, we can sell 25,000 units a year. Okay, so we go to year number 1 equals 25,000 units times $20 a unit. Boom. Let's make that a dollar sign without the pennies, no pennies. $500,000. That's our first year revenue, 25,000 units at $20 a piece. Also, we know that this is going to be the same every year. We're going to sell 25,000 units every year through 10 years at $20 a unit. But note this line here. Annual change in sales price after year 1 is 2.5%. It's called inflation. 2.5%. So we now have to go to year 2 and write in this formula, taking year 1's revenue and multiplying it times 1.025. Hey, Mr. Hassey, I thought you said it was 2.5%. Well, it is. What's 0.025 in a decimal? 2.5%. So we're increasing the whole 1 by 2.5%. So I'm going to take $500,000 and inflate it by my annual change in selling price every year by 2.5%. Oops, I think I put in the wrong number.
Question.
Yes, Dustin.
Is this all supposed to be on the investment line or the sales line?
Oh, thank you, Dustin. Dustin, you are a sharp cat. Thank you. Thank you, Dustin. Yes, it's on the sales line. Thank you, Dustin. Let's go back and do that again. So we'll put our units. Thank you, Dustin. What a moron. There we go. Okay. Now we're going to take that and multiply it times 1.025, which is 2.5%. And we get $512,500. And now we know that our inflation rate every year is 2.5%. So all we do is a little trick in our spreadsheet is grab the corner of the cell and slide it all the way down to year 10. And there's our total revenues over the next 10 years generated off this investment, 25,000 units at $20 a unit in year 1, and increasing in the sales price 2.5% every year. That's a total of 5,601,691. That's our total revenue we expect to generate off this investment. Okay, cool. I gotcha. Now let's work on the expenses. Thank you, Dustin, for helping me out there. I missed that one. Everybody see how I got that line? I'm taking what the variables are, 25,000 units every year to be sold at a selling price, and then after the first year, inflating that selling price by 2.5%. We're basing that on our cost. We're going to sell our product a little bit higher every year. Our next number is right here, our variable cost per unit. That is all the costs of producing this product and managing this product on a per unit basis. It's $8 per unit. It's called a variable cost rate. And if any of you have taken accounting or managerial accounting or cost accounting, variable cost is a combination of all different kind of costs rolled up into one amount. And in this case, it's $8. So we take now in year one, we take, excuse me. We take the 25,000 units we're producing and multiply it times the variable cost rate of $8, and we get $200,000 as our expenses. Oops, let's make that negative because it is an expense. So times negative B11. There it is. That's an expense. So it's 200,000 going out. That's our variable costs for year one. Then look at here, right underneath it. This is also inflated, but not at 2.5%. This is inflated at 2% a year. So now we take that cell, just like we did with sales, and multiply it by not 2.5% as revenue was, but 1.02. 0.02 is 2%. We add 1 plus 2%, that's 1.02. We get $204,000. And now we just slide that over all the way. And there's our variable costs for every year through the depreciable life. And there's our total variable cost, $2,189,000. But as we all have known, or maybe all of us know, there's two types of operating costs in a company. There's the variable cost, but also there's the fixed costs. The fixed costs that are not related to output, they're just fixed costs like debt interest expense, salaries, rent, insurance, costs that have no effect, are not affected by output, but affected by just the nature of their cost being fixed. It stays the same. It stays the same in this year, but it will also inflate in other years. And the fixed costs for this company are $50,000 in year one. So minus $50,000. That's our fixed cost, 50,000 right here. It's given to us. And note the inflation rate for that cost. It's 1%. So now I'm going to multiply the year one times my inflation rate for this particular variable, 1.01, 1%. And I get $50,500. And then I go back and slide it all the way over. And there's my fixed costs throughout the 10 years. And now what have I done? I've now calculated all my expenses for my project. So what is my earnings before taxes, better known as my operating income? It's going to equal the revenue minus the variable costs, the fixed costs, and the depreciation. $150,000. 500,000 minus 250 and $100,000. That's my operating profit that I anticipate generating off this investment. And I just slide that formula all the way over. And there's my earnings before taxes for my project. And now, because this is operating income, I have to take tax out of this. So I'm now going to put equals the operating profit times minus 0.3%. That's 30%, my tax rate. So I'm taking 30% off the operating profit, and there it is right there. And I'm going to slide that all the way over. And there's my taxes I have to pay. That 30% incorporates both federal and state taxes, 30%. And now I can come up with my operating income, my net income, my net accounting income for this project by just taking the operating profit and subtracting out the taxes. And there's my net income. And slide all that over. And just give us a subtotal. So off this plan of an investment of $1 million, we're going to generate 25,000 units a year in sales, generating $5.6 million in revenue, with expenses and taxes taken off of that to get a net income of $1.322 million off this investment. But that's not our cash flow. That's just our accounting income. Remember last week, we did this in Chapter 9 problem. We came up with the net accounting income, and then we had other things that we had to account for to determine the net project cash flow. We're going to do the same right here for this as well. Now I'm going to stop right here and just have us take a look at this and understand what we're doing.
Can I see the EBT formula again?
Sure. Remember, these are all in negative numbers. So I'm taking sales plus this, plus this, plus this, which is basically minus that, and I get 150,000. F7 plus F10, 11, and 12 to get 150,000.
Mr. Hassey, could you
Yes.
just auto summed?
Yeah, you could have done that too. I wanted to show you how that works. That's okay too. Now, I'm putting these in as negatives because I wanted you to see the expenses. Now, what some people might do is just put it in as 200,000, 50,000, 100,000, and then take this and actually subtract these numbers, and you'll still get 150. But I wanted to show you the expenses in a different way, so that's why I wanted to put those in a brackets or minus numbers. Doesn't really matter, as long as you make sure you're subtracting expenses from sales. Dustin, does this make sense? Okay. So we've determined net income that we estimate. Remember, this is a budget, it's estimation. We get our managers, we get our marketing salespeople, we get our product people, our distribution people, our manufacturing people, and we get all these estimates and we come up with these numbers. The depreciation schedule is set by the depreciable life of the asset and how much we paid for it. We paid $1 million, we're depreciating it over 10 years, 100,000 a year. Then it's estimated by our purchasing people that we can get this asset and dispose of it in year 10 for 50,000. Because we fully depreciated it over 10 years, that's a taxable gain. We have to take 30% off that 50,000 as tax on that gain. So we end up net 35,000 in that 10th year. as cash coming in after net income. And now we also have to now add back the $100,000 of depreciation. Add that back every year. Oops. Why? Depreciation is a non-cash expense. We're allowed to use it as an operating expense to reduce our tax liability, but because it's non-cash, it's not really a cash expense, so we're adding it back in as cash flow after we calculate our net income. Now the last section to determine our net project cash flows is we have to determine what we talked about last week, which can get a little confusing, the working capital requirements of this project. In this case, the variable is working capital as a percent of next year's sales has to be at a base of 12%. 12% of our revenue is an allocation that we deemed necessary of additional cash flow to keep the asset operating before we're reimbursed for sales and expenses. So right here in year 0, I would put in a formula equals the first year's sales, 500,000, times negative 0.12. That's 12%. I'm taking 12% of 500,000, and that's negative cash flow in year 0. We did the same thing last week in chapter 9, right here. But remember, last week, as sales change, so did our working capital. Same thing this week. Sales are changing every year. Going up, in this case, inflation. We're raising our selling price. So that means we're going to have different working capital requirements every year. Equals, parentheses, year 2 sales minus year 1 sales times negative 0.12. And I'll explain this madness in just a sec. So what I'm doing is I'm taking the difference between year 2 and year 3 sales and taking 12% of that, $1,500. And what's happening now with this working capital? Remember, working capital is a balance sheet. It doesn't end after every year. It's not like expenses. It accumulates. And notice at the end of year 1, we have $61,500 of working capital allocated for this project. $61,500. Well, what's 12% of year 2 revenue? $61,500. So we're maintaining a working capital base of what our following year's sales are. 61,500. And this will occur every year now because we can see revenues going up every year through year 9. Watch this. I'll slide this all the way to year 9, not year 10. And notice it's adding, we're using additional working capital every year because our revenue is increasing, and to keep that base of 12%, we're allocating additional cash. But then in year 10, just like we did last week in chapter 9 problem, remember, as revenue decreases or ends, we add it all back in, and the net effect of working capital is 0. Well, the same thing here. There's no year 11. So in year 10, all we do is we take 12% positive of the year 10 sales. Oops, put in the right formula, Mr. Hasse, excuse me. Equals year 10 sales times 12%. And we get $74,932 of positive cash flow. And watch how this works out. If we take year 0 to year 10, what's that equal? 0. It's all net. It nets out. We're using working capital here as revenues increase, but then at the end of the project, all that comes back in because we no longer need working capital, and it's a positive cash flow in year 10. People do this for a living and get paid very well for it. Here's a good piece of advice. As you're working on these spreadsheets, every now and then, save the file in case you lose it or something happens and you make a mistake. Always save it because you'd hate to, after doing all this work, you hate to lose it. Now we can calculate the net project cash flow. First of all, in year 0, it's pretty simple. It's the investment plus the working capital. So we're spending $1,060,000 in today, year 0. Our net cash flow in year 1 is net income plus salvage, which there's nothing there now, plus depreciation, plus the negative working capital. And there's our project cash flow for year 1. We're generating 203. Notice the difference between net cash flow and income. It's mainly because of that depreciation. We're generating $203,500 of cash flow. So now with that equation already there, let's slide it on down. And there's our project cash flows for every year, 1 through 10. Which happens to total $2.4 million. So right off the bat, we can see, I think we're onto something here. We're spending $1,060,000 on the investment in the asset and working capital today, and we're generating in estimations $2.4 million of cash flow over the 10 years. Looks like we got something going that's right here. So now what we're going to do now is now show this return in dollars, percent, ratio, and years. Just like we did in chapter 8 and chapter 9. We're going to take this cash flow and determine these things to say, okay, it looks like we're making money, but how's that compared to our investment today of $1,060,000? Let's take a look at that. Now, before I do that though, does anybody have any questions on how I came up with this $2.4 million of project cash flow? Okay. So what's the first thing on our agenda to do? What's this flow of money? What is its value today? And that's called the discounted cash flow calculation. Formula, function, financial, net present value, NPV. What is our interest rate? Well, our interest rate is the WACC we calculated a few minutes ago. 8.83%. That's our WACC. The values are years 1 through 10. F21 to O21. We're now going to take this flow of money, year 1 through year 10, and discount it back at 8.83%, and we get $1,510,000 $832. In other words, our cost of capital is discounting this $2.4 million that we're going to be receiving in the future to what is its true value today. And our net present value is the difference between that discounted cash flow and the investment of year 0. Answer number 1, our net present value is $450,832. What is our return in percent? Formula, function, financial, internal rate of return. And all you do here is under values, paint from year 0 to year 10. E21 to O21, taking the entire years, hit OK, 17.03%. That's our return in interest or return in percent. What's our profitability ratio? The relationship of discounted cash flow divided by the investment of $1,060,000. 1.43 times greater. Our discounted cash flow is a ratio of 1.43 to the investment. You want something over 1. And what is our payback in years? Well, we start out with $1,060,000 invested. The first year we're generating $203,500. At the end of the first year, we've paid back and we still have $856,500 to pay back. In year 2, we take that payback number and add in the project cash flow of year 2. We have that to pay back. Now that I got that formula set, I can slide it on down. And we can see that sometime within year 5, we pay back our money. 1, 2, 3, 4, and what percent is 211? 987 of our year 5 cash flow. 94%. 1, 2, 3, 4.94 years. A little bit under 5 years to pay back our amount of money. We're just taking the payback as we whittle down the $1,060,000. There's no discounting in payback. It's strictly how long until we recoup our investment. A little bit under 5 years. The bottom line is, this is a good investment. We're making money. We're generating almost $500,000 in money value as of today's dollars, far exceeding our cost of capital. Our cost of capital is 8.83%. We're returning 17%, almost doubling. Our ratio is positive, and we're paying it back in less than half the time. This looks like it could be a good deal. Our analysis is finished. You would recommend this to the board of directors of the company, saying, you know what? Our marketing people, our sales people, our manufacturing people give us all their estimates. We put all this into this one analysis. It looks like we're going to make money. Let's invest the $1,060,000 today because we think we can get that back pretty quickly. That's the bottom line in this analysis. Dustin.
Can you click on the $60,000 for the for the net working capital? Is that
Yes.
that's a formula?
Yeah, it's what it is, Dustin. It's taking It's taking the first year sales of 500,000 times the working capital rate of 12%. So 12% of 500,000 is $60,000.
Thank you.
Any other questions on this? Now, here's what I would do if I were you. Right now, sitting in Blackboard is that blank file folder with this hasn't been filled out yet. I would download that and I would try to do this problem on your own in the next day or so. If you have time, try to do it, because then I'm going to upload this tonight and it's going to say updated week 6 capital analysis. So you'll have 2 files in that file folder. One, it's blank that you could work on and practice. 2, then you have the answers in case it doesn't work out. And when you're all done, if you don't get these 4 numbers, something's amiss. You can go back in and see what you missed. All right. I would do that, because this is what's going to happen next. And it's posted now. Here's another capital budget analysis where I give you the variables like this, and now you got to put them together into a capital budget spreadsheet. Now you have the template already, but I would practice that template to make sure you know what's going on, because these variables are a bit different than the variables we just used. Because why? That's the real world. No one project is alike. So now you're going to have to put this information in this format. 2 formats. You're going to have to determine the WACC. You're going to have to then take that WACC and put it into this variables and complete assignment number 3 based on that information I gave you. That's your job this week, due next Tuesday. But I would take a couple of days and just try to put this together, this blank document, and see if you can do it before you attempt to do number 3, because it gives you additional practice. And then when you see assignment 3, you'll kind of go, oh yeah, Mr. Hassey's giving us this a little bit different, but I'm ready for him. I kind of know what he's talking about, because in this project here, in case number 3, you have a debt position. Oh, it's 60-40. That's good. But you have an interest rate on the debt of 6.5%. The tax rate is different. It's 22%. And the firm's beta is 1.5. The risk-free rate is 1.45, and the market return is 8%. These are all different. So you're going to have to incorporate those into your analysis, because these variables are a little different. And here we just did a 10-year project. This project is for 5 years for $750,000. Here's the depreciation. Here's the salvage. Here's the working capital. Oh, the working capital percent is different. It's 10, not 12. There's the inflation, and the inflation is the same for all the variables, 3% for sales, expenses, variable and fixed. It's the same rate for all of them here, where the last one, they were different. Every project has different variables. And now notice something that I throw as a curveball here. Notice in our weighted average cost of capital, the interest rate, or the tax rate is 22%. Okay, use that there. But notice the tax rate for this analysis. It's 25%. Wait a minute, Mr. Hassey, how can the tax rate be 22% and your project tax rate is 25%? Why are they different? Here's why. The company is based in Claremont, California. That's our corporate headquarters. That's where we get the money. This is where we are. This is where we borrow the money and issue stock. This is where we get their money. Our tax rate in Claremont is 22%. Okay. But this plant is going to be in Nevada. This plant and this investment of $750,000 is going to be in Nevada, where they have a different tax rate. the tax rate there, corporate and federal, or corporate and state, excuse me, federal and state, is 25%. So because this is being built and managed in Nevada, it has a different tax rate. Does that make sense? So that's something you gotta have to watch out for. So this is what you're going to do for next Tuesday, is you're going to submit these two tabs. Weighted average cost of capital tab, what is their cost of capital? And what is this analysis for this project of 7 years, not 10, 7. And incorporate that in the variables that I give you in that case. Because if any of you have done your homework and looked at the Road Kings case, the Road Kings case goes out 20 years. Ha ha. Something even more different. This will give you good practice to put all that together. This is assignment 3 for this coming week. Now, as a nice little respite for you all, because this is practice, I will be available up to next Tuesday. If you want to put together your spreadsheet for the assignment number 3, and you want me to take a look at it as a draft, you can go ahead and send it to me and say, Mr. Hassey, am I on the right track here? Is this looking right? I will say you're on the right track. Or I might say, maybe you better take a look at your inflation calculation again. So if you want to, now don't send me this on Tuesday night at 11:15 p.m. I'm not going to be around. But if you want to start working on this over next weekend and want to send me, I know Catherine will take advantage of this. You want to send me this, Paulette, you probably take advantage of this too. If you want to send me your draft of your spreadsheet, I will look it over and let you know you're on the right track. The key here is I want to build your confidence up in putting this together, because you're going to need all the confidence you can to do the Road Kings case, especially those team members of yours who are in charge of those project cash flow questions. That's what you got to do. So I want you to feel comfortable with this. So my recommendation is to do this spreadsheet again with the blank version that's in your Blackboard right now, and try to do it on your own. Once you get that done and it all comes out, then attack assignment 3 and try to do that. And again, the reason why I say this is the most important class, because when you guys take your capstone class, which is, I believe, the 496 class, the last class you take in your business administration program, your professor would ask you this: hey, have any of you guys done a capital budgeting analysis? Yes. You guys know what it means, what the cost of capital is? Yes. Okay, here's a problem I want you to tackle in this capstone class. Go. You'll know all about it. Trust me. You'll thank your lucky stars that you'll have this under your belt by the time you get to that class. And in some cases, the professor who you have the 496 class might not even ask you about a capital budget analysis, but might give you a problem or analysis looking at some variables that relate to this analysis. And by knowing that, it'll give you a heads up in that class. This is huge. And also, if any of you are thinking about going to graduate school in finance, accounting, MBA, management, organizational management, any of that stuff, there's a lot of this stuff in graduate studies, a lot of this stuff. So this will get you ready for that as well. So your job, and the good thing about all this, if I would have gave you guys and gone with a PowerPoint from chapters 8, 9, 10, 11, and 12, first of all, we'd be in class for 6 freaking hours. And you'd be so confused after seeing all these terms and everything going every which way in the textbook, you would say, this is a disaster, Mr. Hasse. But by looking at it this way that we did tonight, concentrating on determining our cost of capital, and look, this template is already set up for you for the assignment 3. It's the same capital structure. You just got to change a couple of these things. And this is all set up for you too, but you got to get rid of a couple of years. But I would do these again on your own in the blank version to make sure you're on the right track, and then go to assignment 3. Because trust me, those students who are not here tonight, and if they're in your teams of your Road Kings case, they're going to say, help me. What the hell is Hasse doing to me in week 6? Because they're not here and they're looking at the video, not knowing what's going on. Yes, you guys who are listening to this video now on Sunday night at 11:30. This will help you guys if you try to do this problem, the blank problem, this version, see if you can do it on your own. Give you good practice. And then if you mess something up or you get confused, you have this template as the answers that I'll post after class. It'll help you immensely. But the key thing, business administration students, as the big picture, what is it costing us to get the capital? And what type of return will we get off an estimation of an investment in an asset? And what can we generate as a return off that asset? These are strategic decisions that are made every day in corporate America and around the world. And you're learning how to do this analysis. It is huge for a business student to know how to do this. Huge. Okay. Did I leave anything out? No, the only thing I left out is you have to go buy the bottle of wine. You have to go and get a lot of sleep in order to do all this. It's up to you now. You have all the particulars. I'm going to save this and post this and call it Update Week 6 Capital Budget Analysis, and it will go into your in-class review file folder in Blackboard. I will post probably late tonight this recording of the session that you can refer to it. But better yet, you know that I'm going to be around tomorrow night. No retirement parties, nothing going on. I'll be sitting here tomorrow night. If any of you have any questions on this, I'll be available tomorrow evening in our Zoom session. And secondly, if you want to put a draft together or have problems, I'm around this weekend to help. And you can use that as a safety net if you get into problems. The key thing is there feeling comfortable, and Dustin asked this earlier, feeling comfortable with the equations in the spreadsheet and being able to interpret the variables and put them into the spreadsheet that fits what you're trying to get at in this information. And it all comes out pretty cool. We're making money. A good analysis. Remember, in case number 3, the only English you have to, the only English you have to do in this case is, notice in case 3, here it is right here. It says here, based on the inputs below, prepare a capital budget analysis for this base case using net present value, internal rate of return, profitability index, and payback in years methods. Determine whether the project is feasible. Please show your spreadsheet calculations and your final determinations of go or no go on the project. So the only thing you have to do is when you're all done and you got your spreadsheet and you did all the number crunching, is down here you would say, if this was this case, you would say go. This is a go. We're making enough money. This project, go forward with it. If they're losing money or the spreads or the profit's not that much, you might say, no, Mr. Hasse, I'm not buying this. It's a no-go. Back to the drawing board. So you won't forget this is worth 5 points on this assignment. If you forget to put go or no go, you're out 5 points. So don't forget that. John Ayala, stay in school. What's that all about? John. Okay. See, that's why you guys are in the blackness of the internet. No way. You're probably watching the Dodgers lose tonight. You're out there, you're hiding in the internet. You're not, you're probably at a bar and you just put this on and then you took off and went to the bar. And I think you're here. That's why John says stay in school. He's probably not even staying in school. He's probably at the bar. So I know how this game's played. Okay. I gotta watch myself. I could get in trouble. And Melanie, next time, turn on some lights. You're freaking me out by that blackness. It's like Halloween.
Yeah, sorry, I told you,
I'm just
I'm at
teasing.
work, so I need to be like in a dark, calm space. I hear too many voices at work.
Melanie, I'm just teasing. You don't have to explain anything to me. Don't even do that. All right, Brittany, did you get a hold of your team member that you couldn't get a hold of?
Yeah, but by chance, did any one of them say they weren't going to be in class tonight?
Yes. I got my notes here.
Wendy or Nayeli?
Wendy got stuck at work,
Okay.
but she
thank
said
you.
she was going to contact you later tonight.
Oh, okay.
I can't believe.
I
I'm-
haven't heard
and
anything.
I'm going to charge you $5 for my message handling here. I'm not, what am I, a receptionist?
You
all
can bill Wendy.
All right. Okay. So yes, good. So I hope that's working out better. Okay. Anybody have anything? I'm done for the evening. You got everything you need to go forward on this. And you know you can, I'll be here tomorrow night. And I'll be around the weekend if you have any issues. Rudy, I have adjusted your grade based on what we were talking about earlier, so that's fixed. If any of you are seeing any problems with your grade posting, be sure to let me know. Rudy found a problem, or he sent me some work that I missed. So if any of you look at your grades and make sure you understand what's going on there as we're going forward towards conclusion of this class. So make sure everything's okay. All right, Catherine, do you have any questions? All right, I can read lips, so you said okay. All right, everybody, then that's it for this evening. Go get them. Trust me, this is the hardest part of the class right now. This is it. It gets easier after this. After this week, no problemo. You guys are in good shape. Get through this week, you'll be in good shape. Trust me. Okay? See you later.
Have a good night.
All right, see you guys.
Professor.
Bye-bye.
Have a good night.
Thank you.